guys, welcome back to the Capital Mindset Show. We're going to be doing a different type of video today. It's going to be actually a kind of a reaction video. It's the first time. So let me know if you guys like this video. If you guys don't, also let me know that. This was sent in by a subscriber. There's already been some reaction to it. I'd say that Strongman Personal Finance has already reacted to this video. So you guys should go definitely check out his take if you guys haven't seen it already. So it's kind of, I think there's a lot maybe in this video, and that's why it's driving up a lot of attention. I mean, it's the first reaction request that I've received, and with those, it's all about the timing, I guess. So I kind of pushed it closer to the front, and I'm going to be doing it here on this quick break I have. I'm a little bit sleep deprived, so I'm also like a little bit cranky. I might be. This is a fair warning to everyone who's a big fan of this person. I might be or seem very harsh at times. Only because if he says something that irks me a little bit, might go a little bit crazier. Also, I want to ask you guys, what do you guys think about this new setup? The audio quality actually should be a lot better than before. Let me know, as well as some of the visual qualities. I'm using a new tool, so it's actually really cool, I guess. But we'll see. You guys let me know how you guys feel about that. On that note, we'll actually get started into this video. All right, so let's actually bring us over here.
Alrighty, we got to talk about market manipulation in this video. Very, very big subject I think needs to be discussed at a time period like we're in right now. And what I am seeing out there is a time period we're going through that this is kind of like the finishing wreck of retail, as I call it, and a lot of traps that are being set for retail right now as we speak. And I'm going to show you a video here that I came across a long time ago that goes into market manipulation and how a lot of the funds will do it, how Wall Street will do it, and you're not going to find a lot of information about this, and I give this individual some credit for at least disclosing this, because what is talked about in this video, a lot of people are very quiet about this for obvious reasons, right? Now, first off, I want to start here with actually SoFi. SoFi, very popular stock in the retail community. It looked like it was maybe coming back just to fall back to pretty much right around new all-time lows for this stock here today. A move like that for a big retail stock like that is very discouraging for the retail crowd. And if we think about what Wall Street ultimately would like, Wall Street doesn't really like people that are individual stock picking, because we're all messing up the market, right? If you look at like the biggest example of this would have been like the GameStop, the AMC situation, right? Of like, hey, you guys are screwing up the market. Like, get in line, buy the index funds, because like you're messing this whole thing up for us, right? And so the fact that retail wants to buy individual stocks, Wall Street for the most part does not like that. They like it if you're giving them the money, right? And they know exactly where that.
Enough. All right, so number one, we did a video on SoFi. It was actually released yesterday. Be sure to check that out if you haven't already. Kind of expressed some opinions about the deterioration of the actual business. And interesting to note that apparently, had no idea, apparently Wall Street wants you to invest in index funds. I didn't know that. For the most part, that's really interesting. I'm learning something new every day. It seems to me that this individual may not know the difference between index funds or ETFs that track index funds held by, I call them asset allocation entities, but asset custodian entities like Vanguard or BlackRock, where the fees are relatively low. Some are lower than others. And you have Fidelity as well, who, has their own index funds for no fees for Fidelity people. And then that's where they want you to be. They want you to be in that because for whatever reason, individual stock picking is I guess, where they don't want you to be. That's where you mess things up. And I assume he's going to get into, because this is, by the title, manipulation. Well, manipulation implies psychological manipulation from the market or from hedge funds onto who? Onto index funds or onto individual investors? Because here's the thing, you're already creating a contradiction within the title and by the premise of your point. But I digress. We note that for SoFi is down for perhaps more of the right reasons than the wrong reasons. I think it is down again today. I think maybe we'll talk about that in a second, but a lot of your companies are down, and I think you're making a video to kind of justify why you're underperforming, because not everyone's underperforming. Maybe people followed you into stocks, but no, my stock portfolio is up this year, as well as a lot of other people as well. It's it's just you. It's not everyone. Okay, maybe again, if you're creating your own little bubble, maybe your inner circle is as well because they listened to you and bought those stocks. But I digress.
That money's going, oh, it's being deployed over here. So they get to add to positions before everybody else does and things like that. If Wall Street comes in, scoops up a bunch of shares, it skyrockets the stock up, they miss out on 20, 30, 40% on that stock. They're like, you could just cost me 20% on that stock because you bunch of retail, you just bought into that before I got into that, right? And so Wall Street's very incentivized for retail to not actually be individual investors. They want them to just invest in index funds, things like that, even like ETFs, right? And you look at the ARK ETF. This is a big one that I think they want to destroy. And the main reason is Cathie Wood is looked at as kind of like, I don't want to call it like a hero to the retail investors. I wouldn't necessarily call it that, but like a big figure, right? Of like
all right, she has an interesting past. Just look into it. What she's done before. She's been here, done that before, and so they want you out of individual stocks into index funds or ETFs. I can sympathize that they do want you in ETFs, and Cathie Wood is an ETF. ARK Innovation is an ETF, and that's a actively managed ETF. So they want you in actively managed funds and actively managed ETFs. They're actively managed, all right? That's where the fees are at, not in market cap weighted indexes that are pre-programmed and they just like let them go. Well, I hope you don't get into like
somebody that's successful that's picking individual stocks. And she gives hope to other folks that pick stocks, right? And so the idea is crush Cathie Wood, crush that ETF, and you.
She's an ETF. You just said that they want them in ETFs. Why are you making an exception? She's just an actively managed ETF. There's so many of them out there. You're just picking one and you're just highlighting one. So are they wanting everyone to get into actively managed ETFs? Do they want them out of actively managed ETFs? Why would they do that? That's where the high fees are at. They want them in low-cost index funds. Okay, I'm a person who I have no index funds in my portfolio. Okay, my viewers know this. I think it's fair to be objective here and not just make up some rambling nonsense, which I think it's going to get worse and worse. But I know that, okay, I'm a little bit more usually reserved in terms of criticisms. And usually if there's a video that makes references to you, it's not direct. I only maybe say something direct if I'm on someone else's live stream, but on this channel it's less direct. But come on, man, this is up there with the.
It'll be very discouraging to anybody that's in retail that was looking up to her a couple years ago as like a god. Now they look at her as like, oh yeah, she failed. Her people are failing, then I gotta fail as well, right? So crush Cathie Wood, crush the ARK ETF. If you look at something like Tesla, there's an interesting trap that's being set up here with Tesla right now, where
conveniently saying this before perhaps a correction occurs.
Tesla's been doing obviously
has nothing to do with valuations. It's just the hedge funds, bro. It's just the hedge funds.
Very, very well in the market. The trap that I see coming here with Tesla, and it's a trap I've seen before, is Wall Street is setting retail up for the folks that aren't getting into the funds yet and haven't get thrown in the cards that have gone to index funds. They want everybody to kind of pile into a stock like Tesla that's popular in the retail community. And the reason being essentially is you see it's holding up really well. It's doing really, really well. And I can tell you as soon as things slow a little bit from the demand side because of, let's say, a recession happens.
Okay, that's not the, okay, there's a lot wrong here. Retail might be piling into Tesla, but not because the hedge funds want them to. Retail piles into Tesla because retail is inherently emotional. That's the whole point of why retail tends to underperform. Actively managed people who pick stocks tend to underperform because of emotions. And then we have, just stupid picks. But before that, we have emotions. This is why Peter Lynch says the most important organ in investing is the gut, not the brain. The metaphor that he's trying to say, or the lesson he's trying to instill in everyone, is that emotion is the number one reason that causes people to underperform. And it's emotion in a variety of aspects, not just simply, it's down, I'm scared, I'm going to sell. No, it's also actually becoming infatuated. That's an emotion. Infatuation, desire, love, and all that, that's emotions. You're still investing with emotions if you just become obsessed with a stock. And, it's kind of poetic because I'm looking at a channel that is quite obsessed with a select few stocks. And I say obsessed because they're almost blindly saying that even though we have objective evidence that they're underperforming in terms of business metrics, not the stock. Ignore the stock. Put that to the side, because this is an individual who would come back and say, hey, but I don't care about the stock price. I care about the business fundamentals. The business fundamentals for a lot of the companies you talk about are deteriorating. Ergo, the only way you can justify the investment in them now, and we'll actually get to some assumptions you made in the past, is through an emotional aspect, through an emotional framework that which you yourself devised in order to make your own justification for why you're investing in. So it's an endless little circle jerk that you're doing. And then, you have some followers that unfortunately are also implicit in this little circle jerk. Some of them are going to see through that, and they're going to be like, okay, this is like no-brain nonsense. But we're right now getting to a point where you're basically stating that this stock is going to go down, not because of valuation, right? And Tesla's a valuation story in the sense that why I think it's going to correct, not because the business is actually performing worse and worse and worse. So retail is going into Tesla because it's the one that's gone up or been stable, and it's kind of like becoming that retail safe haven, right? Sure, it's gonna come down, right? I think that is very possible because retail doesn't move things. Retail does not move things in either direction. So again, your premise is predicated on the fact that hedge funds care necessarily about what a lot of retail does. They care in small, minute instances when we sell order flow, which we'll actually get to in a second. But the premise right here that you're talking about Tesla is no. What caused Tesla to go up in the first place is institutional money, not retail money. Retail's been invested for this for a while. Now, it hasn't been as much as now. Now that it's up a lot of retail wants to own it. A lot of retail bought this thing at 600, 800, heck, 1,000. People have been buying in 1,000 too. They still think it's going to go to $3,000, $6,000. Retail's piling in. Who do you think's selling to them? Now, if it goes down, it's because there's greater selling pressure than buying pressure. You're just completely throwing away the fact that perhaps, right? It's such a conceited point, but perhaps it might be a valuation problem. Of course, it's not a business problem. And again, I'm not a Tesla hater. I love Tesla. I love the car, right? I enjoy driving my Tesla. But I don't agree with this whole point of just, this is an amazing company that can do no wrong, blah, 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 blah. I don't agree with that.
Let's say interest rates keep going up and not as many people want to buy vehicles, things like that. Dude, they're ready to set that stock down 50% plus. They'll do it. They've done it before. They've held that stock down for many, many years before. While retail bought in or other folks bought in, they gave up, they shorted, they gave up.
Who do you think was on the other side of the trade? There's plenty of institutions that own Tesla. Heck, you just pointed out Cathie Wood. Cathie Wood is institutional money. I don't care what you say about that. She's an ETF. She's institutional money. There are plenty of others, Loop Ventures, all these other institutional money managers, right? They're all invested in Tesla. Tesla moves on institutional money, not retail money. What the heck? So we're already breaking the logic tree here, and we haven't even really gotten to the crux of it.
They went long, they gave up, and they've done it before. They'll do it again with a stock like Tesla. And I even know a lot of people on YouTube, for instance, that have 80 to 90% of their entire portfolio in a stock like Tesla, right? Which honestly sets a horrible example for the market. I don't have any stock that has even more than 20% in one stock, right? But they're trying to set that as an example.
I'm just going to assume that's true, but I think that's false. I think that's false. Predicated on the fact that you don't actually reveal your full portfolio at all times and all your allocation and stuff like that. I'm not going to say that you should or should be forced to. I know that YouTube is your brand. This is your income. This is how you make money. So you have to maintain a certain image. Okay, all well and good. We'll get a little bit more into that as to what your strategy is and the implications of your strategy. But yeah, I understand why you do that.
Have everybody kind of pile in there, and then they'll kill that stock off as well, right? And all of a sudden, that will kind of be like, oh my gosh, like we can't even make money in Tesla now? Like, are you kidding me? This is the way they set it up, and they make you believe, like, because imagine you're retail and you own a SoFi, or you own other individual stocks that have been getting killed. Meanwhile, Tesla, you start to think, oh,
not all individual stocks are being killed. Not all individual stocks are being killed. This premise does not make sense. They're not targeting retail. These are the YouTube stocks. You don't understand. You created this. I mean, you're an entertainer at the end of the day, right? So you're like, what, top 10 largest YouTube channel. You're an entertainer, right? Why are you such a good entertainer? Well, because your vernacular is very low, right? So having such a simple vernacular allows you to be, easily digestible. And then that serves a wider audience. Capital Mindset or these some other channels will probably never be like a wider audience. And that's all well and good. This is not going to be my income. It's there's no way it's ever going to be like my main income. This is just a passion project. I know that this is your income. This is your pathway to riches. However, you know, let's be real, or let's be understanding as to what the point that we're at. Okay, you are victim, or not you're a victim. People are victim to you in a sense that, you know, you gave them very noob tier analysis, and we'll actually get to that. What the heck? What? Okay, I just noticed this. Why the heck does he have a price to sales ratio metric right in front of me? Is this your app? Is this a screenshot of your app? Do you really have a price to sales metric as like your thing that you're looking at for this company? There's so much to cringe at. There's so much to cringe at. Anyways, you're an entertainer. Let's be frank. So you are very entertaining to watch. I'm kind of thoroughly entertained by watching you, even though I am cringing a little bit. You know, your voice is I'm just kidding. It's not soothing. Can you imagine? But anyways, you put me to sleep. No, I'm kidding. But to be serious, let me be serious for a second. You're an entertainer. You're very easy to digest again. And I think you point up a video or something like you're saying people don't understand. No, people understand you. People understand you. Maybe you don't understand yourself. Maybe you confuse yourself because you're breaking a lot of logic trees, and that would be understandable. So you're formulating a logic tree with broken logic trees. And in order to fix a broken logic tree, you have to do a further break of the current logic tree that you're undergoing, which is often very difficult to do because you have to identify it, and then the logic break is even bigger. But anyways, regardless, so far we have the presumption that institutional money wants you to get out of individual stocks because they do psychological things that affect people who are invested in individual stocks. And then what they want you to do is to go into index funds, ETFs. We're going to ignore that there's a difference between any of them. And they also hate Cathie Wood, which is an ETF, which is an actively managed ETF. And that while institutional money is what caused Tesla to go up in terms of the volume of purchase orders, and now that retail money is what's buying in here at the top, for the most part, the grand majority of it, they want to bring it down. And I presume he's going to say because then they want to buy in again and then ride it back up again, even though they're the buy volume that causes it to go up. And it has nothing to do with the fundamentals or anything like that. That's where we're at so far.
Just put all of my money in Tesla. That's a smart idea, right? Because, I mean, shoot, it's been performing so well. They'll kill that as well, man. Just wait on it. A Corsair Gaming company that this isn't like this some money loser. It's a profitable company, great cash flows, great business model, very, very proven. They don't want a stock like this to...
False, false, and false. No, they're not proven. They're not proven yet. No, they don't have good cash flows. They don't have even that much growth going forward. Your analysis, and if I'm being frank with you, Jeremy, here, your analysis was noob tier, right? We made videos on Capital Mindset going back last year, and I know that it upset some people when we were coming out with it because it was a bold claim that Corsair was overvalued because you are the authority on this matter. And I started to notice this because this stock actually has a great story as to the creation of Capital Mindset. So my ex-co-host Austin was invested in this stock, and he has an accounting background. He wanted to get into stocks. You kind of are, again, you're a good entertainer. You're a good sales guy. You can sell someone on the idea of something. You make it, your vernacular being so simple to absorb makes it very easy for someone to kind of get behind this and say, oh, yeah, great. And they don't know much else about the stock. And please tell me that's not a price to sales ratio. It is a price to sales ratio. Oh my gosh. All right. Anyways, you're probably looking at this. You're like, oh, price to sales ratio of 1. This is cheap. Noob tier analysis. So then you didn't, for some reason, understand, which we stated in 2021. Okay, it wasn't like a secret. 2021, and now we weren't the only ones. I looked at it and I was like, and by the way, I'll be fair. You don't also are the only one who does noob tier analysis. I will say that also Everything Money is subject to noob tier analysis as well, and I've seen it. So I won't say that you're alone in that matter. But it's pretty egregious that what you did here with this one, because for some reason it was beyond your comprehension to understand that a lot of demand was pulled forward. And we're kind of separating ourselves from the fact that Corsair's products aren't the best on the market. For example, when I purchased all my new products, I went with Razer for a lot of things, but nothing really Corsair. I didn't really get any Corsair. And it's not because I have a disdain for the company. I don't care. I just want the best value. For me, I'm a customer that's willing to pay up more for the highest quality, top tier quality, and it turns out that's not Corsair. And I also have a lot of audiophile people who love audio equipment guys. So for those of you who don't understand or don't know what that is, they would say to me that Elgato's equipment is subpar. It's kind of like the entry level, right? And so, you know, they're not even really competing seriously in that aspect. And it's more of like a dropship model in some instance because they don't even produce most of the products. They outsource the production, then they stamp their logo on it, and then they sell it to the end consumer. That's not a strong, powerful moat, right? That's not a strong business. They just have this brand, right, that hopefully people love. And then again, it's not that much different. There's a lot of competition in that space. It's not a good business. It's objectively not a good business. The moat is not there. The margins are not there. They had a anomaly going on, and you couldn't see that. And now you're saying that it's the institutional money. Well, I'll tell you right now, Eagle Tree Capital is in there. We stated this in a previous video. We know an individual who works at Eagle Tree Capital in the investment side. I'm not going to name drop them, but they're a very moral individual as far as I know. And I've known them for quite some time now, and they are not looking to just rug pull, right? It's not institutional money. Institutional money probably was exiting out besides Eagle Tree, but exiting out mostly up top, selling to retail, and retail was pushing up in the sense of exuberance. Now they are at the market cap size where retail can have an effect on them, sure. And it's quite interesting that your channel focuses solely, not solely, but quite often it's content on these small entities, right? And one theme that I'm noticing just so happens, coincidentally, you're buying a lot of heavily shorted companies. Coincidence, just coincidence. And heavily shorted small cap companies, not necessarily growth companies. I've heard some people say, you know, he invests in speculative growth companies. Not really. I mean, there's speculative growth, and then there's whatever this is, right? I'm not talking about Corsair in this specific instance. I'm talking about these other ones.
Succeed right now because this is a stock that obviously a lot of retail's in, and so even a stock like that, they're going to do everything in their power to try to keep this stock down, no momentum at all in something like a Corsair Gaming, right? They want folks to be in index funds. Index funds are easy for Wall Street to deal with because the money just flows in from people's paychecks or whatever, right? They see that money going in the index funds, it gets distributed around the stocks, and if you're planning on any sort of buying in positions, exiting out of positions, if you know everybody's like piling into index funds, you can see the money coming in. It makes your job on Wall Street very, very easy. You don't have anybody screwing it up for you.
They're totally not the competition or anything, guys. We're talking about index funds, ETF index funds. So ETFs that track the index. That's totally not the competition. That's totally not what everyone's kind of judged upon. And yeah, totally the hedge funds don't want, like, they just want you in their competition. They don't want you in them. Right? Or they don't want you in actively managed funds, or they don't want you in a position where they could manipulate. I don't understand that. So they can manipulate you when you are, you know, statistically, because obviously, like, let me just say this. It doesn't matter what we all say. I can tell someone, do not fall for something statistically, or sorry, emotionally. I can say that over and over and over again. Doesn't mean they're going to do it. People are very emotional in many ways. And people who even say they're not emotional are emotional. Okay? They're lying. So if I want to, you know, control you, do I want you in an index fund, or do I want you as an individual investor trying to do your own thing? And then I know that you're inexperienced. So I follow what is called dumb money. And you know, traditionally dumb money means money that is passive. That's index investing. That's called dumb money traditionally. And then smart money is called not passively managed, actively managed. Well, when I say dumb money in this context, I'm saying like quite literally dumb money. Newer people to the market, people who don't really know what they're doing, that kind of thing. And I want to target them. If I'm smart money in the sense that I know kind of what I'm doing, I want to target dumb money and figure out a way to basically put myself in a position where I can benefit from them. In some instances, that is finding out what it is they're investing in. Well, how do I do that, right? I hope he gets into that.
For you don't have anybody messing up the whole system, right? You get to see that money coming through. You know, oh, there's going to be $10 million put into this stock over here. There's $20 million being put over.
It sounds like you're describing order flow, but you're not. You're describing an index fund. That makes no sense. So it's like we're completely ignoring the fact that sell for order flow exists. And, you know, you have stock like, okay, Robinhood, right? So Robinhood, you have free commissions, no commissions or whatever, but you're paying somehow. Well, that you're paying in order flow. Well, okay, going back to my example, I want to find out where dumb money is. Oh, it almost seems like I have to pay the broker, and then I can find out exactly where the dumb money is going, and then I can position myself in ways to profit from them. So I can front run something like AMC, which definitely was hedge fund money that caused the most recent up, and then they sold into that retail exuberance. Easy profit there. And again, you know, I totally want them in index funds. That's totally how I profit. That's totally where I want them, all right? You know, and again, we're probably going to hear a lot of, you're saying a lot of things affecting someone emotionally. Well, index funds, the purpose of why someone would want to own them is to avoid that emotional aspect. It's so that, you know, it's a passive investment, not an active investment. In order to be a good active manager, you got to be emotionless, or, you know, you got to tamper those emotions down a little bit. So all that you're saying is kind of contradicting itself, but we'll see.
Over here in this stock, there's 100 mil coming in next week into this stock. You can set everything up. It's like, it's easy. It's a piece of cake, man. But the more folks that are actually individual stock picking, the more this is going to screw up the whole system for you in the end. And you, as somebody on Wall Street, right, big money, you don't want anybody screwing this up. If anybody screws this up for you, it can be the...
Maybe I'm like a little bit too sleep deprived. I'm a little cranky, but what the heck is that thing in the corner? Loyalty over royalty. Abundance over scared. Look, the lines don't even line up. Like, the OCD-ness in me is like thinking like that was made by a kindergartner. Like, who made that for you? Did you pay someone to make you that like logo? It's trash. I mean, I don't know. You probably made that yourself, because there's no way I'd pay someone to make that for me.
The difference between you making another, you know, $50 million, another $500 million, or not, right? We're talking about big money at the end of the day. I want to play this video. I think it's a good video. Jim Cramer, I know he gets a lot of crap all the time, but I do give him credit, and I know some people like to destroy him here because they say, you know, you were part of this, right? When he was running his hedge fund.
This video is so cringe because it's taken a lot of the parts are taken a little bit out of context, and people extrapolate bad theories from it. It was shared around a lot in 2020 from the Wall Street Bets crowd. And, you know, well, there's an underlying premise that I guess he's going to miss, and it's going to go right over his head, which is emotional.
But at the end of the day, I just appreciate...
I'm Aaron Task, joining up market, and as of right now, it's actually...
I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Similarly, if I were long and I would want to make things a little bit rosy, I would...
All right. The word rosy was just used, which implies some sort of sentiment. Sentiment implies psychology. Psychology implies humans, right? So human beings actively moving money. So if I am trying to make things rosy, I want to affect other humans' behavior. An index fund, believe it or not, is not a human. Believe it or not, is not a human. So we're kind of destroying... The argument's being destroyed by itself. So again, what we've done is we've formulated a logic tree. We have several breaks. And then so I don't know if you see the breaks, but the breaks are definitely there because we're using points that contradict our previous points to then make a current point, all in an effort to justify why we're underperforming. And saying that why we might underperform in the future as an easy cop-out by saying it's just the hedge fund's fault because they're targeting me, etc.
I would go in and take a bunch of stocks and make sure that they're higher, and maybe commit $5 million in capital to do it, and I could affect it. What you're seeing now is it probably is bigger market now. Maybe you need $10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game.
By the way, this is not a longer term thing that Jim Cramer's describing, which is the funny part. He's talking about intraday thing, committing a small amount of capital to cause a certain kind of movement that cascades into something else. You're talking about stocks that are heavily shorted perpetually, not like, oh, they did this one thing and it cascaded and caused a massive sell-off from all these retail investors, because that's at the end of the day who will sell, or other institutions, right? They can cause each other to sell. They all try to destroy each other. It's a dog-eat-dog world. When a hedge fund takes a position, another hedge fund might take the opposite position, right? One shorts, one goes long, then the other one, goes under, the other one doesn't, the other one benefits, right? They're not just like, say, targeting retail because like, oh, it's super fun. Some of them target specific retail stocks, of course, because they think, in their opinion, that's dumb money, right? And I mean that in the literal sense of the word. That's dumb money invested in that stock. Those people don't know what they're doing. They're invested in a terrible company. Right? They're going to dilute a lot, which we'll get to in a second.
Game, and you can move it up and then fade it. That's often creates a very negative feel. So let's say you take a longer-term view intraday, and you say, listen, I'm going to boost the futures, and then when the real sellers come in, real market comes in, they're going to knock it down. It's going to create a negative view. That's a strategy very worth doing when you're valued on a day-to-day basis. And I would encourage anyone who's in the hedge fund.
All right, I'm going to just skip over this whole Jim Cramer thing because you guys can all watch this video. This guy's kind of
various guys who cover the bonds, and you say, ignore the bond action. What's really happened is the Fed is very frightened about.
But in summary, he describes a lot of short-term moves that hedge funds can do, and this guy over here on the left-hand side, he says like, oh yeah, what happens if you're not meeting your percentage that you need, and then your company's going to doubt you? It's like, yeah, because they're short-term minded a lot of times because they have to keep money in them. So yes, they do a lot of short-term moves. There's not like a perpetual downtrend that they cause in stocks. They do it like over the course of maybe a month, maybe a couple weeks. They do their move, right? And if it cascades, that's because retail is so psychologically frail, or other investors who are in it are so psychologically frail. And we're talking about small microcap stocks. In particular, we're talking about high retail invested stocks, such as the ones that you promote on your channel. But we'll get to that because, you know, there's some actual other examples of some noob tier analysis that I want to cover. But, you know, skipping over this, I just want to hear your thoughts. I'm here for your thoughts, Jeremy.
Yeah, I think so. But, you know.
Give me thoughts. Here you go.
And so now knowing that that is going on, right? Knowing that you have to deal with that, you have two options. You can say, well, market's manipulated. I want no part of the market, right? Or you can say, okay, I just understand that's part of the game. I'm going to focus on my plan, my long-term objectives. If they want to send stocks down to ridiculous prices and I get to buy those stocks, cool, whatever, okay? If they want to send stocks to a way overvaluation, if they want to make up rumors, positive, negative, whatever, cool. I'm going to deal with that. I'm going to stick with my plan. I'm going to have a diversified portfolio of 10, 20 stocks. If I get some insane dips, I'm going to keep buying those dips. And if it's a great company that's going to grow over time, believe me, I've never seen it over the long term where that stock price was not reflected. A company that continues to grow year after year after year, revenues, their profitability, everything just keeps.
All right, this is where I'm going to pause. So you're saying a lot of statements here that are easy to agree with, right? No one can disagree with, but that's the nuance of it. It's like, okay, it's like me saying, I only buy good stocks. I think people should only buy good stocks. Who disagrees with me? Please let me know out there if you disagree with me. I disagree with the statement, you should only buy good stocks. Of course. Now, question after that, what do you mean by good stocks? Okay, so he's saying a lot of things. Oh, broadly diversified portfolio and good companies that are growing over time. It's like, okay, how are they growing? What are they doing? So many things are missing from that statement that lets me to believe that, you know, you're just looking at the surface level. And again, you know, your vernacular being quite simple, it kind of fits with the brand overall. That may be a little harsh, but cranky Fabio here. So there's also like the noob tier analysis, and I'll be nice and I'm going to help you change your face real quick. There we go. So much nicer face here because I don't want to be too mean. That was a mean face. So for example, taking a look at something like Tattooed Chef, right? You made a statement, and I referenced you in the past, not directly, because again, this is more of a direct video because it's a reaction video. But you stated that and good thing I have a good memory, but Tattooed Chef was kitchen sinking their estimates at about 233 million, and that was without any acquisitions, right? That was the revenue estimates, 233 million. You stated they would, during that same time period, produce about 250 million. Around there, 255, 250 million. Not only were you wrong, but you were so far wrong because they went below what management said. So they weren't kitchen sinking it. In fact, they were being aggressive, and that miss was in addition to all the acquisitions that they did. So let me just be frank with you. If you are incapable of properly estimating the sales figure, of course you're not going to estimate the profitability, okay? Because the profitability is much more difficult to actually get precise because there's so many other factors that go into it. There's so many different line items that you have to expense in order to come up with a profitability. So if it was a profitability projection, I would have given you some slack. But it was a revenue projection because for some reason you value revenue tremendously. And I can see that by just, you know, you're giving us all the little psychological hints. You have price to sales ratio as the first little thing that shows up next to the stocks that are conveniently on a low price of sales, right? So Tesla looks a lot cheaper when you say 20 PS or, 1 PS for Corsair. Well, Tattooed Chef, you're probably looking at sales. And I know that your analysis was predicated upon forward P estimates and just making up your own numbers. I don't know if you hired someone to do your analysis for you. If you did, you should fire them because that's pretty egregious. That's very bad. This is also kind of someone can extrapolate from that and say, you probably don't actually understand the business if you're not capable of actually projecting out into the future what the sales figures are going to be. And you should probably create a range next time so you don't leave yourself open to such, open to be criticized in that aspect. Create like a range, but like you were so confident that they were kitchen sinking it, right? And no, turns out they did worse than that. And then you also stated something about the balance sheet being super good. Well, not only did they have $200 something million in cash back then, now they have 90 million. So we see a cash burn rate. We know that the gross margins are collapsing. It's a temporary, let's say it's temporary, but they're going to have to make a lot of investments in order to bring back gross margins to your projections, right? If they even come close to that. And that's gross margin. It's not even the net margin. So we're talking about gross margin. So they're going to need a lot of investment with diminishing cash. What do you think they're going to have to do? They're going to have to dilute. That's going to affect the valuation, but you don't take that into account because you're kind of a, let's just face it. I don't know what to call it I'll just call it a noob tier analysis, right? If you came up to me with that analysis, I kind of think it's funny. I think you're telling me a joke, and then, I don't know what I'd say to you. I literally don't know. But that's just one example of many. Of course, you're not the only one who's done noob tier analysis. Of course, there's other people that have done noob tier analysis. But Corsair was another example. Honest was pretty noob tier analysis as well. Also taking a look at Smile Direct Club, another noob tier analysis. Planet 13, or think whatever that company was, the cannabis company, another noob tier analysis. You simply just looked at the stores and what's going on in the stores, not paying attention to the actual fundamentals of the business, and you just looked at sales. You consider sales, this is how noob it is. You consider sales to be the paramount fundamental aspect of the business, and then the cash on the balance sheet, and maybe debt. That's what you consider to be paramount. That says it all.
Better and better margins, all those things. I've never seen it once in my 14 years being in the stock market where that stock price was not rewarded over time. And so this is very, very important to remember, because all this short-term stuff, all this manipulation, all these games they play, that's all it is in the end. It's all a short-term game, and you can actually benefit because, like I said, sometimes they'll send these stocks down way further than really they deserve to go. Some of these stocks, they go down to $2, $4, $6. They don't deserve to be down there, right? They got good balance sheets.
Says who? Says you. Okay.
Like they got an actual business model that's growing.
Everyone has a business model. It has to be a sustainable business model. It's like, okay, your vocabulary is kind of, I'll give you a pass on that.
Growing and growing. But they'll send those stocks down there. And it's, as an investor, you just got to stay laser focused on the long term on these companies. And if you get those dips, you got to buy those dips. And you just got to kind of call it a day there. And you got to understand they're going to play a lot of games in between. They're going to try to get you scared. They're going to try to get you to sell out. They're going to try to get you to get.
But they want you in index funds. So their strategy works. So the strategy is based on psychology. Again, you see where we broke the logic tree. We want you to go into index funds. But we have our tactics that work on you psychologically in order for us to profit. And in order for them to work psychologically, we target retail. So we want retail to go into, see, like what's going on.
Give up. That's all part of the game. And so you just got to understand that. So yeah, hope you guys enjoy this video.
All right. I think that you kind of made this video on the fly, and you probably really should have thought about your position a little bit more, because you really did leave yourself out. And I can see why this video was requested for me to react to it, because I think everyone's kind of seeing exactly what kind of, frankly, lunacy is being stated here. It's a very incoherent argument. Maybe matches the investment philosophy of the creator. So, maybe it's all part of the theme here. And yeah, I mean, I don't really know what else to say. Look, you're a good entertainer, no doubt about that. Investor, you have your brand that's like making you always look good. And here's the thing, your strategy of consistently buying the dip is sustainable by you because you prey on newer investors. I've had at least 10 individuals reach out to me from your course. And I think I'm a small channel. I'm a pretty small channel, right? So the fact that so many of them are out there shows me how much money must you have taken from people and given them absolutely nothing in return. In the sense that some of them, unfortunately, and it kind of like saddens me a bit, saddens me a lot actually, because some of them took out debt to pay for those things, right? And supposedly, your sales practitioners encouraged the use of credit cards to pay for your services, for your education. For someone who looks at price to sales ratio as a primary valuation factor, unironically, right? And looks at forward estimate, because I don't think you're maybe you're not capable of making forward estimates, and that's all well and good. There's plenty of creators that acknowledge that, and they say, according to analysts, blah, 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 and then they say the caveat, analysts could be wrong. Analysts could always be wrong. Your confidence level is incredible in terms of the ability, and that's probably why people are drawn to you. I mean, I'm looking at this video, and I think you might actually believe the things you say. And that statement of confidence psychologically is very powerful to viewers. It really draws people in terms of believing in what you have to say. And all well and good, you've built a great brand for yourself. You're very lucky. Look behind you. You got the Tesla. This is how you've made your money. So, I mean, maybe I'm being a little bit harsh towards this end point, but I mean, a lot of the other stuff is like, I'd be a little sussed out because, I don't know how technically legal all the stuff that you're really selling to people. But yeah, I've talked to at least now 10 subscribers that are, ex-subscribers of yours. Maybe they're still subscribed. I don't really care. The point is, frankly, from what it appears to be, they were shafted. They were shafted hard. They paid a lot of money that they could have invested into their own portfolios, but that money, those dollars, are in your portfolio. And so this constant churn of new people, because there's always new people, is going to fuel your investments going forward. And the worst part is that in and of itself is what allows you to continuously grow your portfolio and invest in these speculative companies. So, I mean, let me be also frank. So you're also introducing a lot of people to the markets, and all that's well and good, but you're also going to shaft, not shaft, but it can be quite harmful to a lot of people. And that's my subjective thought, right? It's just opinion. And you're stating, I guess, your opinions here, but my gosh, man, my gosh. Okay, so now back to my lovely viewers. Welcome to the hallway of knowledge. Look at these books. You think I value money? No, I value knowledge. I'm just kidding. Ty Lopez reference. But regardless, I thought this video was interesting. And yeah, let me know if you guys want me to do another reaction video. When you want me to do a reaction video, try to send me, I don't know, just send me like a comment, and don't try to post the link to the video. Just post the title of the video, the creator, and all that, and I'll be able to do that, because the link, sometimes YouTube doesn't like you to post links, and it'll just automatically delete your comment or not show me your comment at all. Unfortunately, it doesn't even put it held for review. It just doesn't show it. So yeah, on that note, guys, I hope you guys enjoy this video. Let me know down below if you guys kind of agreed. Do you think I was being a little bit too harsh on him, or not harsh enough? Some people might think that. Yeah, just let me know your thoughts, and I'll see you guys in the next one. Bye.